Lazy Investor here. Today I want to talk about balancing your portfolio, controlling your emotions, controlling your risk. So when you start investing, whenever you start investing, most people trade with emotions. I find that most people that trade with emotions have failed to plan, therefore they have planned to fail. With that being said, you need to study different strategies and come up with one that suits your risk tolerance. For this particular Robinhood account, I started with $1,500, and we're going to talk about balancing the portfolio and managing your risk. So the way I balance the portfolio is I have some dividend stocks, I have some long-term swing trades, and I have some, I hope, to be long-term buy and holds, but everything's going to have a stop loss, a trailing stop loss, and I'll get into that in a minute. Pardon me. So initially with the $1,500, I set a 5% portfolio diversification limit. With the exception of Apple, I wanted Apple for the split, but let's take Visa for example, because I followed that rule initially with Visa. So here at my portfolio diversification, it's currently at 5.8%. I originally purchased this with a 5% limit. Now, how do you determine that? You take your portfolio value right here and you multiply that by 5%. At $1,500, that was $75. But Visa has increased in value since I purchased it, and I have been stopped out of some trades. I have sold some trades, and therefore my portfolio diversification ended up increasing. But on top of that, I also made some purchases with Visa. As time went on, my dollar cost average was a little under, I think it was a little under $202 a share originally, but now it has averaged up because I might be wrong, but I think I purchased in here. Let's see, I got some dividends coming up on it. Let's see, I bought $50 more at $211.85 on the 28th. So I actually ended up buying on Friday. So I bought basically right as the market opened, it looks like. I don't know how I bought it to $11.58. It must have been on a dip. But anyway, so I increased my position with that because the portfolio size increased, and I have a risk tolerance for this one right now because, as you can see, it's been on a steady uptrend. It has had some dips, like right here at 10 a.m. would have been the best time to purchase that, and that's actually about the time where I consider purchasing most of my stocks if they dip. 10 a.m. Eastern Standard Time is when a lot of stocks have picked their direction for the day. The volatility has slowed down, and this is not a rule. This is just kind of a generalization. Not every stock is going to follow these rules by any means. So let's flip through the stocks that I currently hold right now. SPHD is a monthly paying dividend stock. One of the reasons I like this particular stock is if we scroll down here, let's just take a look from the top down, I guess. My dollar cost average is 33.37, and I have just under 5%, 4.5% of the total portfolio in this stock right now. It pays monthly dividends and is getting ready to pay me dividends again on Monday. And there's another dividend at the beginning of this month. What am I? Here we go. This is what I was looking for, the About section. So the SPHD tracks a dividend yield weighted index comprising the 50 least volatile names chosen from a short list of the S&P 500. So everything that's in this ETF is low volatility stocks from the S&P 500 that have been collected together to pay dividends every month. You can put this into the drip method, and eventually it'll get to the point where every time you receive a dividend, that'll be another share that can be added to this until it's buying its own shares, until it's paying you $30-something per dividend payout to buy another share. So then we got Apple here. This one I wanted it for the split. I believe Apple is going to do really good in the long term, and now I have a little over 4.5 shares of it. Cisco, I bought it on a dip play. This is a higher risk play currently. Let's just flip to the 3-month chart. You see that big dip right there? I think that was a bad earnings or something of that nature. I've charted it out. It is in this channel right now where it has spent the last, what's that, about 2 weeks, give or take. I expect it to make a recovery over time, but right now it is just in kind of a dipped position. I do have a positive return on it, but I do not have so much of my portfolio into it that I am worried about losing a lot of money on it and making a large impact on the total portfolio. So since we're here and we have one full share of this, let's talk about setting up a stop loss just in case, since this is one of my higher risk swing trades. So on Robinhood, you would go to Sell Cisco, order type, trailing stop order. Leave it at the default percentage. Set your desired trailing stop. Now, understand that a trailing stop is wherever you purchase the stock, that trailing stop is going to follow it up. It will never go down with the stock. It will always go up with the stock. So what do I mean by that? Let's see if we set a 5% trailing stop here. That's going to give us an estimated credit of $40.07. So with that being said, Cisco, if it were to drop to $40.07 on the bid ask, I would be stopped out. However, if Cisco decided to trail up to $70 a share, that 5% trailing stop loss would follow Cisco up to, let's see, $70 times 5%. The new estimated credit if Cisco made it to $70 with a 5% trailing stop is $66.50. Now, like I said, it will not go down. So if Cisco went down to $39 a share, I would be stopped out, hopefully before it, unless it was after hours. I would be stopped out at $40.07. Now, you cannot do a trailing stop with fractional shares. You can only do the trailing stop with whole shares. So on SPHD here, I could set a trailing stop for the 2 full shares that I own, but I would be stuck with the decimal 15 shares right here. So My only exception to the 5%, no more than 5% portfolio diversification was Apple, because I wanted that split, and I do believe Apple will do good in the long run. I do not own any Apple products, no MacBook, no Mac desktop, no iPhone, any of that nature. So this is just me being kind of speculative. Apple is a worldwide company, so I do believe that they will continue to go up in the long run. And going back to the trailing stops, so here's the trailing stop. Let's say we set it for 5%. You can choose to sell. I have 4.5 shares. I could sell. I could set a stop loss for just half my position. I could set it for 3 of my shares. I could set it for 1 share. If I set it for 1 share, that'll tell you what its estimated credit is if Apple decided to go down to 119.23 on the bid ask. That's where I should, in theory, get stopped out at and receive a credit for that, so I wouldn't lose any more money. I'm actually currently down overall in this position, but it was a risk that I was willing to take because Apple is going to be receiving a lot of attention. They're going to have new products coming out. The split. I just it's going to cause hedge fund managers to consider the idea of rebalancing portfolios. So I felt like it was a good investment for this particular portfolio. So we were talking about no more than 5% of the account's value. So right here, we would take $1,638.87, multiply that by 5%. That would leave me with $81.94 of purchasing power towards my next stock. And I would still be at my 5% total account value portfolio diversification. So that's a way of managing the books, so to speak. That way no one stock is going to be so heavy that it's going to cause you to lose a large portion of your portfolio. Alright, so let's see here. Let's look at a midterm to short-term swing right here. MDT. I have a target of about 112 on this stock. Let's see here. Right in this area was what I was looking at on a better charting system, not Robinhood, mind you. But it seems about 112 is kind of a good area for potential resistance on this stock. Now, mind you, it is a target, but it's not a necessarily let's go ahead and sell it position. A target price should be viewed more of a potential point of problems, something that you could see, maybe a pullback, a sell, something of that nature. But that doesn't necessarily mean you should be selling there. It would just be keep an eye on it. And if you don't want to keep an eye on it, you set the trailing stop and either get stopped out or just let the stock keep going up and your trailing stop following it. You'll eventually get stopped out, but that's okay. You're just locking in profits at that time. If you do get stopped out, then maybe that stock is having some weakness, and you could potentially get back in after the weakness is over. Let's just take a look at March, for example. Just about every stock suffered at the end of February or middle of February through March. You would have got stopped out, but you wouldn't have had to suffer all the loss in between. And then whenever you noticed that volume was picking back up and the economy was doing good and it started uptrending again, then you buy back in and set your trailing stops and ride it back up. And that's just an example of risk management. With fractional shares, you just have to have that discipline to say, okay, the 2, 3, 4, 5% stop loss would have triggered at this point. I need to sell here and not just, let it ride down and lose money. So we've got buy and holds, long-term swings, short-term swings, and dividends in this particular portfolio. Let's see. I'm just looking to see if I have any upcoming dividends besides SPHD. Let's take a look at, try to think about a stock that I purchased and got stopped out on. Let's see here. I can't think of anything that I've recently got stopped out on that would be in this Robinhood portfolio. Give me just a second. I keep a trading journal. Let me just kind of flip through it real quick. And you might not see it on screen because the recording software that I have will not allow pop-ups or other screens to be viewed. Ah, here we go. Well, can't get stopped out on that because it was a fractional share. Well, regardless. What you would do is you would find a stock that's uptrending, like an example in one of my previous videos. You'd go in, purchase it, set your 2 to 5% stop loss, and just let it ride. You'll eventually get stopped out, but you'll just be locking in those profits between here and there. I hate that I couldn't show you an example of that, but that's just the way it goes sometimes, I guess. Anyway, so we don't have a bad portfolio here right now, that's for sure. Lots of green in this portfolio, and I have been posting trade ideas, charts, things like that in the Discord group, and more education materials in the website that I will put in the description of this video. As far as options trading goes, we'll eventually get into options trading, but I don't feel comfortable doing that yet because I like to buy in the money calls with plenty of time. So let's just pretend like the market is open right now and we've got a lot more money. Visa, we think it's going to continue to uptrend. I like to purchase something with about 45 days of time and in the money. So let's just say I feel like Visa is going to continue to uptrend and earnings is going to be good. They've got a potentially new product coming out or new service. So I would purchase this particular call right here with the expectation that it's going to go up. And I would wait until there was a moment of weakness as the price is trending up. Let's just say it gets up to $220 and has a moment of weakness and falls back down to, I don't know, let's say 219, I would go ahead and sell my call option. No reason to let all of that money that we made leave the table. We might do some vertical call spreads as the portfolio is building up, but the next stop for us is going to be the $2,000 mark. Once we hit $2,000 right here, we'll access Robinhood Gold, get the margin. I think they offer up to $1,000 at no fee, just the $5 a month fee, and we'll just try to build this account up as high as we can. Hopefully I won't lose a bunch of money. You know, that's what the stop losses are there for, but hopefully we'll make some good decisions, and we'll invest wisely as we continue to move forward here. I would love to see this account in the tens of thousands of dollars sooner than later, but the only way to do that is to make wise investment decisions. Potentially, I haven't decided if I'm going to yet or not, add some money every week, maybe $100 every week or something like that, because as you're investing, you shouldn't just limit yourself to your base amount of money. You should always consider adding more money to the portfolio to help increase your purchasing power. Remember, 5% of whatever this number is. Pardon me. So if we had $3,000 of purchasing power, that would leave us at $150 per stock that we can purchase. Okay, so we have talked about short-term, balancing the portfolio with short-term, mid-term, long-term swings that could potentially just be buy and holds, and dividend stocks. We have talked about setting your stop loss, managing your risk tolerance, dealing with your emotions. Investing can be fun, but once you've you feel like you've potentially mastered one particular style of investing, it gets boring. Always look for another way to invest, but make sure it makes sense to you. If you can't explain your investing style to somebody, if you can't explain it to a younger teenager, say, here, this is what we're going to do, then I wouldn't say that you necessarily have a true mastery of that subject yet. Let's see, is there anything else that we should probably go over? Let's just talk about this little dip right here. That was a cheap options play that I made. The initial premium was $60. By the time the stock market opened, the stock was trending down, and I lost money on it. But I kept the cost low at $60. It was under the 5% total of the portfolio. So yes, I lost money on it, but I didn't lose so much money that it completely destroyed the portfolio. I didn't go all in. I didn't YOLO it. I ended up losing like $30, give or take, on that position. And that's all about balancing the budget. So here it is. I took a loss, and I did not really do any more trading. I opened a couple of positions. I opened UPS, I believe, but I know I opened up BRK and MDT. So always think about balancing the budget, balancing the books. Try not to get head over heels into one stock. If you get stopped out, I wouldn't suggest immediately getting back into that stock. Let momentum determine which way that stock is going to go. And once a stock has a good, clean, clear path, then consider getting back in. Let's just look at Visa over the last 3 months. It was in this channel, and then it finally broke out of the channel and it's been on a clear path up. I went over that in another video. Check out the rest of my videos for ideas on potentially how to pick your stocks. Alright guys, invest wisely.